So yesterday we talked about the accounting, principle ethics. And in terms of ethics, we talked specifically about confidentiality. We talked about conflict of interest. And we talked about, what was the other one?
Integrity.
Integrity. Thank you. And so, as an employee, you have a certain code of conduct that you have to follow that is in accordance with the company that hired you, right? But as an accountant, in addition to that, you have a higher calling that you have to adhere to, and that is to the profession of accounting. The whole profession of accounting, the cornerstone of it is believability. So without ethics, we don't have a profession of accounting. We provide financial information to users. They need to be able to rely on that information, that it's accurate and that it's timely. So we talked about this yesterday in detail. Now today I want to talk about the accounting process, more specifically the accounting cycle, and then touch on another couple of things within that cycle. So you should have a handout on your desk that summarizes the accounting cycle with an image, but then also shows you each step in the accounting cycle. And this is true specifically for a service business, and that's how we started out this course at the very beginning of the semester. All right, so step one in the accounting cycle is to check source documents for accuracy and analyze transactions into debit and credit parts. Okay, so step one in the accounting cycle is to analyze the source documents and determine what the transaction should be, right? And so when you determine what the transaction should be, it should have a debit part and a credit part. So with double entry accounting, at least two accounts should be affected, and your debits should equal your credits. All right? The other thing to keep in mind is that in order to follow GAAP, or generally accepted accounting principles, we have to use accrual accounting. And do you guys remember what accrual accounting is? Accrual accounting is recognizing expenses when they're incurred, recognizing revenue when it's incurred in the period and the time that it happens, rather than waiting for cash to change hands. Now, cash basis accounting allows you to wait for cash to change hands. Accrual accounting, you want to recognize that revenue when it comes in, when the transaction occurs, or you want to recognize that expense when that expense is incurred, okay? And so the second step, after you've analyzed the source document, you've split your transaction to a debit and a credit part, is to record the transaction in the journal, right? So record the transaction in the journal. Now, when you record it in the journal, you are putting in the source documents column where that information came from, because you want to have some evidence or some justification for why that transaction was entered into your permanent accounting records in your journal, right? And so if at any point you're audited, the auditor could look at that transaction and that auditor could trace that transaction back to a source document that justifies or provides evidence for that particular transaction being part of your business transactions. You don't want to have a bookkeeper that's paying their personal electricity bill or their personal gas bill using the company's money, right? And so in order to prevent that, one way to prevent that is to make sure that you have a requirement for a source document before anything can be put into your permanent record on your journal, or in your journal. And then step 3 is to post the journal entry into the correct ledger, right? And so when you post, you're continuing this audit trail, because in the ledger, you're putting the journal page, the journal and the page number that transaction is coming from, that's being posted now to the ledger. So now there's an audit trail from the ledger to the journal, and then from the journal to the source document. So there's an audit trail that traces all of these together. Remember, in real life, a lot of this is gonna be automated, right? So the posting process is not gonna be as cumbersome as it was when we were doing it step by step in this class. But just keep in mind, even with that posting process being automated, there's still an audit trail created between that entry on the ledger to the journal, and from the journal to the source document, okay? And then step 4 is gonna be to prepare your worksheet. So then at the end of a period, you're gonna prepare your worksheet. Remember that a worksheet is not part of the permanent records of your organization. The worksheet is the accountant's scratch paper, right? And that worksheet starts out with a trial balance. And the purpose of the trial balance is simply to see that debits equal credits, okay? The trial balance is gonna list out all of your accounts. And you wanna make sure that your debits equal your credits, because you wanna make sure that that accounting equation, assets equals liabilities plus equity, stays true. And so in order to make sure that stays true, so far you've done double entry accounting, it's an accrual process, and you know that each transaction has an equal debit and credit part. Well, this trial balance, the first step on the worksheet, is making sure that your debits equal your credits. If they don't, then you know something went wrong in the first 3 steps, and you need to go back and fix that before you continue on. All right, so once you've created your worksheet and you have an idea of what your financial statements will look like, the next step that you need to do here is step 5, is make adjusting entries. And the reason why we make adjusting entries is so that we can follow GAAP. And GAAP tells us that we need to use accrual accounting. And so the primary purpose of adjusting entries is to make sure that we're recognizing expenses that were incurred, and we're recognizing revenue that was earned in the period that it was incurred or in the period that it was earned. Okay, so the primary reason for adjusting entries is to follow accrual accounting, so that expenses that were incurred are recognized and revenue that was earned is recognized in that particular period. All right, so when we were doing adjusting entries, most of our adjusting entries dealt with prepaid assets, right? So we had prepaid assets, we used them up during the period, so we needed to expense them during that period. And essentially what was happening then was we're increasing our expenses, decreasing the related asset, and that was our adjusting entries that we made. After you've made adjusting entries, then you're ready to prepare your financial statements, right? And so your financial statements are your income statement and your balance sheet. Those are the 2 main ones that you'll create coming off of the worksheet, right? And so remember, the income statement is gonna capture your temporary or your nominal accounts, okay? So temporary, nominal, those things are synonymous. Those are the accounts that are captured on your income statement. They include your revenues and your expenses. These temporary accounts are gonna be set back to 0 before the next period or the next accounting cycle starts, okay? And then you have your balance sheet, and your balance sheet is gonna capture your permanent accounts, also known as your real accounts, okay? The balance sheet is gonna have your assets, liabilities, and equity accounts. Your equity accounts are gonna look a little bit different depending on if you're dealing with a sole proprietorship or if you're dealing with a corporation. But generally, your equity is gonna have some sort of capital associated with it. So we call it capital when we're dealing with a sole proprietor. With a business, we'll call that retained earnings, right? And so that equity is a permanent account. It's gonna show up on your balance sheet. And also, in addition to it being there on the balance sheet, if you wanted to look at your equity section in more detail, you would, for a corporation, look at the statement of stockholders' equity. And the statement of stockholders' equity is gonna summarize all of the things that changed for your equity section of your balance sheet during that period of time. So things that could have happened is you could have issued more stock. You could have paid out a dividend, right? So you might have had net income, decided to share the wealth, and so all that will be captured in more detail on your statement of stockholders' equity. That rolled up retained earnings will show up on your balance sheet. So you have your permanent accounts on your balance sheet, your temporary accounts on your income statement. Another word for temporary is nominal. Another word for permanent is real, when you're talking about balance sheet accounts versus income statement accounts. All right, then your next step after you've prepared your financial statements is to journalize and post closing entries. All right, so you're gonna journalize and post closing entries. And again, this is a handout that you should have in front of you, or it's also written on page 228 of your textbook. So journalize and post closing entries. So what is the purpose of closing entries? The purpose of closing entries is to set your temporary accounts back to zero. So your closing entries are gonna have 4 steps. First, you're going to close all of your revenue accounts. Okay, so basically all of your temporary accounts that have a credit balance, you're going to debit them and you're gonna close it to an account called income summary. Remember, income summary doesn't have a normal balance side. It does what we need it to do so that we can get through our closing entries. We use it and then we lose it, right, until we need it again. All right, and so we're gonna first close out all our revenue accounts or all of our income statement accounts with credit balances by debiting them and then pushing that all into income summary. Then the second thing we're gonna do is close all of our expense accounts or all of our temporary accounts with debit balances by crediting them, and then we're going to debit income summary, right? And so now income summary should have a balance in it. And if income summary has a debit balance at this point, then you know that you lost money during this period of time. If income summary has a credit balance in it, then you know that you've made money or have net income during this period of time. Revenue minus expenses equals your net income, okay? And so the third part of your closing entries is going to be to close that income summary account. And you're gonna close that income summary account either to capital or to, in the case of a corporation, retained earnings. So if you had net income, then you'd be debiting income summary to close it and crediting the capital or retained earnings account, essentially increasing your equity, right? And then your fourth and final step, now if it was net loss, that would be flipped. Your fourth and final step in the closing entries is to close out your drawing account for a sole proprietorship, and you would close your drawing account by debiting the capital account and crediting drawing. And for a corporation, you would want to be closing your dividends account, I believe. So if there's dividends, you're gonna close it to retained earnings by debiting retained earnings and crediting dividends, okay? So 4 things in closing entries: close all your income statement accounts that have credit balances to income summary, close all of your income statement accounts that have debit balances to income summary, close your income summary account to either capital or retained earnings, and then close your drawing account or your dividends account to capital or to retained earnings, and you're done with closing entries, right? And so after you've journalized and posted all of your closing entries, your last step in the accounting cycle is to prepare your post-closing trial balance. All right, so when you see that word post, that means after. So post-closing trial balance is going to only how do you spell trial? So this post-closing trial balance is going to capture only accounts that still have balances in them. So after your closing entries, the only ones that should still have balances in them are your permanent accounts. And so your post-closing trial balance should look like a lot like your balance sheet in that it only has assets, liabilities, and equity on it. All right, so this is the accounting cycle for a business, and you've done this twice. You've done it for a sole proprietorship and you've done it for a corporation. And so it's important that you guys kind of, to some level, commit this to memory, okay? At some extent, if they ask you about any particular step in this process, you're familiar with it. Like, why do we do adjusting entries? So we can follow GAAP and do accrual accounting. Recognize revenue when it's earned, recognize expenses when it's incurred. Why do we do closing entries? So we can set all of our temporary accounts back to zero and prepare for the next accounting cycle, right? If they ask you about the worksheet, is it part of the permanent records? No, it's not. But what is on the worksheet that's important before we continue? The trial balance. What's the purpose of the trial balance? To make sure that our debits equal our credits before we move forward. All right, so that's the majority of what I have for you today. The other things that I know that should be fresh on your mind is LIFO, FIFO, what that means, how you apply it, right? Weighted average, the lower of cost or market. We didn't really test too much on the lower of cost or market, but I want you to remember that, keep that in mind. The lower of cost or market is one of the ways that we can value our inventory. That's the most conservative way, that basically whatever we've chosen as our method, LIFO, FIFO, or weighted average, then the lower cost or market is gonna say, hey, we're gonna compare whatever those were that you chose to the current market value of your inventory, and whichever one is lower, that's what we're gonna go with. Why? Because we never wanna overstate our assets. Overstating our asset is a way that we mislead investors, we mislead people that might loan us money, right? And we don't wanna do that. And so LCM as an inventory method is the most conservative approach to valuing our inventory or assets. And for a merchandising business, typically inventory is our most valuable asset, or our heaviest asset. All right, so on Canvas, you should see 2 quizzes. One was regarding the things that we discussed yesterday and a couple other things on there. And then today's quiz is on there as well, discussing what we discussed today. And so between now and 11, I want you guys to use your time to prep for this NOCD test. You can go ahead and stop that video.